Banking sector performance in Q3 FY25 was led by PSU banks. PSU banks outperformed private banks on key parameters like loan growth, net interest income growth on a sequential basis, asset quality as well as return ratios. However, they lost out to their private counterparts with respect to net interest margin. But before we come to comparative performance between these two, let's take stock of the industry trends seen in Q3 FY25. So, Indian banking sector reported one of the lowest net interest income growth in last few quarters. So deposit growths are coming in at a huge cost, and unsecured growth, especially for private banks, is moderating, thereby impacting the net interest margin of the banking sector. Sequentially, if you take a look, operating profits for the banking sector declined the highest in last 5 quarters. This was also due to the fact that treasury income was strong in Q2 FY25 for many banks. Profit after tax declined for the sector sequentially, third time in last 5 quarters. So coming back to PSU versus private banks, the net interest margin of PSU banks declined by 11 basis points quarter on quarter, and that of private banks actually improved by 4 basis points sequentially. Now PSU banks had entered the low yielding corporate segment in the last few quarters, which actually was vacated by the private banks at lower yields. So this impacted their ability to hold on to healthy net interest margins. Now PSU banks have not been into unsecured lending in the retail segment over the last few years. Guess what? That actually saved them from asset quality woes. So for 5 quarters in a row, their quarterly annual slippage ratio has been lower than that of private banks. In Q3 FY25, the slippage ratio might be at historical lows for PSU banks at around 0.7%. PSU banks have outperformed private banks on asset quality. So gross NPA ratio and net NPA ratio of the PSU banks actually declined on a sequential basis in Q3 FY25, while gross NPA ratio and net NPA ratio of the private banks increased quarter on quarter in Q3 FY25. Loan growth of PSU banks on a year-on-year basis has been better than that of private banks for second quarter in a row. Now, private banks' loan growth is actually impacted due to slowdown in loan growth momentum that you are seeing in SDFC Bank. So, return on advances on an annualized basis has actually declined for PSU banks and private banks on a sequential basis. However, PSU banks have outperformed on return on advances if you take a look at the 5 quarters. So over the last 5 quarters, their return on advances has improved by 39 basis points when compared to 15 basis point decline for private banks. Overall, lenders focused in the microfinance sector like Utkarsh Small Finance Bank, Suryodaya Small Finance Bank and ESAF Small Finance Bank have seen their net interest income decline between 10 to 14% on a sequential basis and from +9 to -19% on a year-on-year basis. Now, these 3 lenders have seen massive operating profits decline. On a year-on-year basis, it's ranged between 27% to 56%, while on a sequential basis, it's ranged between 11% to 44%. Now, ESAF SFB and Utkarsh Small Finance Bank are the only lenders to report net loss in Q3 FY25 amongst all the banks. Now, pain is not only on the asset quality but also on the top line for some of the lenders who are actually focused in the MFI or microfinance sector. Let's take a look at the outlook. Now, loan growth may pick up in Q4 but may remain sluggish on overall basis. Liquidity deficit is coming down in the banking sector. Deposit growth may inch up a bit, but the cost of deposit will remain elevated. So you can expect the net interest margin of the banking sector to remain under pressure relatively more for private banks than PSU banks. Slippages will remain elevated, which can impact the return on assets for the banking sector. Valuations, they remain inexpensive but may remain at current levels until earnings downgrade cycle ends.